Hey guys, welcome back to the Dutch Investor channel. Yesterday I talked about the balance sheet and I explained it in basic terms, and today I want to do the same for the income statement. I believe this to be a short video, but I think it's an important one before we get to the cash flow statement. So let's get started. So the income statement. This is how I would draw an income statement, and at the top there would be revenue all the way at the top. It's always the case with an income statement. And revenue is basically all the money or value that's been generated through sales. So I want to keep this simple. So let's say you have a lemonade stand. I guess that's an example that's often used. And you sell lemonade to customers, then selling the product. So the lemonade, all the money that you get from that would be considered revenue. And below revenue, there would be cost of revenue. So in that same example, if you're still selling lemonade, the cost of revenue is going to be every cost that is directly related to the revenue, and I'd like to emphasize on directly. So if you hire someone to sell the to sell the lemonade, sorry, then that will probably, well, I can assure you that is not considered to be cost of revenue because it's not directly related. What is directly related is the cup, the lemonade itself, stuff like that. So that's something that you need to consider. There is some kind of subjectivity to it, and we'll get to that later, but that is all you need to know. And when you have the revenue and you deduct the cost of revenue, what you get is gross profit. And that's that. And from the gross profit, you can deduct the operating expenses. And this is, I guess, a summary of all the other expenses related to the operating of a business. So could be administrative costs, could be the chairs and desk that you need to be writing off, everything that you have as an expense but is not directly related to the revenue. So I guess you could say it's indirectly related. So in a lemonade stand, you could say that if you're sitting on a chair while you're selling it, that could be an operating expense. If you have the paper or you're writing stuff down, you're writing nice letters with it when you sell it, yeah, that is considered indirectly because it's not necessary to generate the revenue. So if you have the gross profit and then you deduct the operating expenses, then you get the operating income. Another word for an operating income is earnings before interest and taxes, also known as EBIT. This will become more clear if I show you the next one, or the next few things. So let's get right to it. Interest expenses. After the operating income, you will deduct the interest expenses. Interest expenses are if you have debt and you need to pay off like the debt, you probably also are paying off or paying some kind of interest rate, and those are considered expenses, and those will be put in the income statement. So those will be put here, and if you deduct the interest expenses from the operating income, you get income before taxes. It's basically clear cut because if you look at the earnings before interest and taxes, yeah, if you then take the interest expenses off, then yeah, all you have left is earnings before taxes because the interest is already deducted. So when you have that and you go to the next one, there's one thing left, and those are the taxes. So the tax expenses, that's basically how I refer to it, and you deduct those from the income before taxes. What do you get? Net income, also known as your net profit. Basically the money that you've actually generated as a profit, like bottom line. So I think this is pretty straightforward. So that's why I'm probably going to make a short video about it. But I would like to gauge you a bit when it comes to like to get your interest. So I want to trigger you a bit, and I want to ask you, where would you put asset depreciation on the income statement? So I guess in a fancy YouTube video you would have like a 10-second countdown so you can think. So I'm gonna be quiet for like 10 seconds. You can think a bit and then I'll come back to it. So back to it. Asset depreciation is a cost. So when you have an asset on the balance sheet that we talked about yesterday and it is losing value, then those are considered costs and they will need to be put somewhere in the income statement. And like if you have decided it could be in the cost of revenue, you could be right. And if you said it would be in the operating expenses, you could be right as well. Why? It really depends on the business, and this is why I always say that you need to understand the business. Because if you don't understand the business, you wouldn't know where the asset depreciation goes to. So let's say I am, let's just stick to a gas company or like oil and gas. Asset depreciation in general, when it comes to the fields would be considered cost of revenue. So you would put the asset depreciation at cost of revenue. But if you have a office building, then those are not directly related to the cost of revenue. So if you were talking about the asset depreciation of an office building, you would put it at operating expenses. So it could very well be the case that if you have a oil and gas business and you're looking at the income statement, that you see multiple asset depreciation on different kind of uh, expenses. I guess I would refer to it that right now. So keep that in mind. But if you don't know what kind of assets they have, then you don't know where to put it. And if you don't know how the business is run, then you don't know where to put it either. So it's important to understand the business. And it's important to know what you're talking about when you're talking about the assets. So I have another example. That's general and administrative expenses. Where would you put that one? I'm going to be quiet again for a few seconds. So I'm hoping that you thought it would gonna be here, operating expenses, because in general, and yes, that's no pun, it would be there because most businesses do not have a revenue that is generated through administrative expenses. But if you look at an booking.com or an Expedia, then everything that you do, and if you don't know what kind of companies those are, it's like mediators for travel services. I made a video about that earlier. Everything that company does is basically just administrative stuff. So everything that they generate through sales, also known as revenue, it could be very well be the case that that is a direct cost of the revenue. So in that case, it's a bit subjective because you could say, well, it's operating expenses, or you could say, no, it is cost of revenue. And if you look at both income statements and you look at the Yahoo Finance from Booking.com and Expedia Group, then you will notice that one person, or one company, I should say, sorry, writes it here, and the other one writes it here. And yeah, that's subjective. So it's something that you need to understand. Is it that important? No, because bottom line, it will always have the same effect. But if you are going to compare gross profits, or you're going to compare other ratios or something like that, or numbers or percentages, then you need to be sure that these costs that we're talking about, that they are written or at the same spot. So either it's cost of revenue or operating expenses, and if it's different, then you probably don't want to use gross profit. Then you want to stick to operating income for comparison, or net income, if you will. So there's one more thing, and we're basically done with the income statement, but I want to end with something that you should know before I start with the cash flow statement, and that is that the cash flow statement starts with net income. And that's going to be unusual, because if it starts with net income, why don't you just continue down the income statement, right? But what the cash flow statement is going to do, the cash flow statement is going to show us where literally all the cash has been flowing. So it's basically in the word. And in order to do that, they're going to start at the net income. So what have we supposedly received from customers? And then it's going to look at all the adjustments cash related in the balance sheet and the income statement, and it's going to put all those adjustments in the cash flow statement. And when they have done all that, then bottom line, you will get the operating cash flow. So how much cash has actually been flowing through or out of the company. But it starts with net income, and that is when we'll go through the cash flow statement. That is where I will start. So keep that in mind. And yeah, I hope the income statement is clear to you. I don't expect it to be that difficult or something that you didn't know, but before I start with a cash flow statement, I need to go through this. And yeah, be aware of the subjectivity that is in these statements. And I'll be making another video about the income statement in the future, and then we'll be looking at actual companies, and we're gonna look at the risks involved in the income statements and the traps and the things that you need to be aware of, and asset depreciation and G&A, or the general and administrative expenses. Those are something that you need to be aware of the traps basically that I've just been going through. So that's it for today. I thank you for your attention, and if you enjoy or learn something, please leave a like, because I do want this to be an educational channel that is growing. And for now, I wish you guys a great evening.